Hello, everyone, and welcome to another edition of Brick by Brick, brought to you by Parvis. My name is Robert Lefebvre. I'm a dealing representative at Parvis. We are joined today by Dylan Kent, Director of Capital Markets at Heartwood Investments. Dylan will take us through the unique offering of Heartwood. But before we get started, a quick disclaimer. This content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offer to sell or solicitation of an offer to buy any securities. A little bit about Parvis. We are a tech-driven platform and an exempt market dealer licensed in all 10 provinces. Our mission is being to provide all eligible and accredited investors access to institutional quality investments like Heartwood Trust Income Fund that we're going to discuss today, making the process smooth and accessible for everyone. So for more information, please visit our website at parvisinvest.com. And with that, I will hand it over to Dylan Kent. Good morning, Dylan.
Good morning, Robert. Thanks for having me. Happy to be on. Happy to be hosted on the Parvis platform here. So, like you said, today we're going to be talking a little bit about Heartwood Trust, which is our multifamily growth and income fund that's available on the Parvis platform. So I'm going to talk in some depth on our strategy, who the firm is, what we do. So we'll get into that. So kind of our defining mission, if you will, is Heartwood is building a new generation of purpose-built rental housing. We aim to deliver stable income and long-term asset value for our investors. And we do this by developing a new generation of climate-resilient, purpose-built rental housing in high-demand markets across Canada. So just to kind of touch on a high-level overview of how we're set up and how we're structured. So Heartwood Trust is our fund. It's an open-ended private real estate fund that provides investors with access to a institutional quality portfolio of rental housing, and that utilizes an institutional investment strategy. So the fund invests in new multifamily rental development. It allows investors to create wealth through the initial capital growth phase, and then with the option to hold for the long term a stabilized portfolio of income producing assets. The fund currently has a stabilized or a secured portfolio of shovel-ready institutional grade rental assets. We've secured these at a very low and attractive cost basis. And what we do is construct and hold for the long term climate resilient, future-proof assets using best-in-class design, really to create vibrant, livable communities for our tenants. So we'll get into the strategy and sort of the returns in some more detail. At a high level, we're targeting around a 20% average annualized return for our investors. So the portfolio, as you can see here, currently we have 14 urban infill sites. These are all currently in Toronto and the GTA. We have a site in Ottawa, so they're all Ontario based at the moment. But we see this as a scalable strategy. Urban infill works in a number of cities in Canada. So while the portfolio currently is Ontario based, we're actively looking at opportunities in other markets as well. So the 14 projects represents about 2,600 units of housing. It's about a bit over a $1.5 billion portfolio. And those projects are in kind of various stages of completion. So we've got 2 sites that are completed and leasing. We've got 2 more that'll be entering construction in the next few months, with a third probably towards the end of the year as well. And then the remainder in kind of various stages of planning and approvals. So just to kind of talk a little bit at a high level on the current state of the rental market, we're bullish on rental in the long term in Canada. I think opportunistically, it's a great time to sort of be at this stage where we're creating new rental that will hit the market in sort of the next 3 years or so. Obviously the market, the real estate market in general, in a lot of areas in Canada has come off kind of the all-time highs that it was hitting regularly for a long time. Rental, no different. We've seen vacancy tick up a little bit, kind of across the board. again, coming off all-time highs, but we still view the structural issues around rental as a great long-term investment, mid to long-term investment. There's a big government push at kind of all levels of government, federal, provincial, municipal, to deliver more housing. There's structural undersupply. While things like immigration have fallen off the kind of all-time high rates, which probably to a healthier level, we still have a high current population in Canada. We have low vacancy, even though vacancies have ticked up slightly. Like I mentioned, it's still, 3.1% national vacancy rates remain near historic lows, and we see the sector, particularly after the next couple of years, once we've sort of chewed through some of the condo supply that's on the market currently, to go back to sort of a pretty tight rental market, which is exactly when our portfolio will sort of hit the market in stride. So yeah, we'll talk a little bit more about the team now and Heartwood in general. So Heartwood was founded by these two gentlemen, Tim Blair and David Constable. They both bring very complementary but different skill sets to the table. So Tim, he's a real estate investment banker by background. He's spent the past 20, 25 years working for some of the largest institutional real estate investors. He worked TD, Manulife, Triovest, and he's done a variety of different real estate deals and work all across the world. At Manulife, he utilized similar strategies to what we're working on at Heartwood now. And then David's an architect by background. He was one of the principal architects at KPMG Architects, which is one of the larger Toronto-based architecture firms. And he ran their sustainability and innovation lab while he was there, worked on a number of very interesting projects over his tenure there. And so Tim and David teamed up. Heartwood was founded about 6 years ago through this opportunity to develop this portfolio into new build rental, really with the strategy of building durable, long-term, future-proof assets. Since then, the team has grown to about 30 professionals. We're kind of cover all the bases of a vertically integrated shop. So we've got development expertise, construction management in-house. We've got a deep investments team, and have brought a lot of that design and experience in-house. So we'll talk in some detail now about the strategy in particular. So Heartwood, and I think this is sort of the key to understanding our strategy is this graph is we're getting involved, and most importantly, the investors are getting involved at construction commencement. So, when you think about how investors can get involved in real estate in general, usually you're either participating in a development deal where you're creating a new type of real estate product, or you're buying a stabilized asset or into a fund of stabilized assets and earning income off of that. So our strategy does both. We're creating new rental buildings and then holding them for the long term to earn income off of them. Investors, just due to the open-ended nature of the fund, can sort of participate on their own investment time horizon. So if they want to be in kind of more on the development value creation phase, they could sort of exit after the bulk of that is done. Or if you've got a bit of a longer time horizon, you could participate and earn income off of the bumped up basis created from the value creation. So when you think about this graph here, it's sort of broken into three sort of segments. So development, and typically when people think of development, the riskier phase is your what's called entitlement risk. So that's your planning and approvals. You're going back and forth with the city or municipality to deal with all the different submissions and design, zoning, all of that, and that's where a lot of your risk is, particularly on timeline. You can get big delays in those sorts of periods. Heartwood, we have separate capital outside of the Heartwood Trust Fund that deals with all that. So by the time an asset is ready to be rolled into the fund, it is starting construction commencement, meaning that investors aren't exposed to the planning and approval risk. That's a key differentiator. And the most important part of that is that we're transferring in the assets at the unentitled fair market value. So we don't take any sort of lift off of the planning and approval work that we do to get those sites ready for construction. They're rolled in at cost, meaning that the upside is passed on to investors, while the investors are protected from any planning and entitlement risk. Then we go through the construction and lease up of the building. We manage construction risk through fixed price contracts. We bring in any external construction managers early in the process. They get a good feel for our strategy and design, and then by the time the properties are rolled into the fund, we've got fixed price contracts in place to manage cost overrun risk. Then we lease up, and like I mentioned, hold for the long term. Once the portfolio stabilizes, the income component builds over time. So as I mentioned a little bit before when talking about the team, we're a vertically integrated firm. We employ a heavily data-driven, systems-based approach. We use data, I think, very interestingly in the real estate world. We have a data scientist on staff. We've developed a number of different proprietary systems that help us in a variety of different ways, everything from underwriting the investments themselves to managing different costs and budgets throughout the construction process, and then ongoing monitoring of the portfolio, everything from real-time monitoring of the properties themselves to comparable market rents and that kind of thing. So we've got all of this expertise in-house, and I think that's a big differentiator for us to create long-term value creation. So go to the next slide here. So talking a little bit more about how we deliver these risk-adjusted returns. So this strategy that I touched on the previous graph, it's a pretty proven out institutional investor strategy. A lot of big, whether it's pension funds or large institutional investors, utilize this approach. It's typically called a build to core strategy, where you're building and then holding for the long term. From an institutional investor's standpoint and from investors coming into this fund, there are several advantages to this. Your options in the real estate world typically are to buy an existing asset or to build it yourself and own it. So the build to core strategy has some downside protection built in. You're creating value just through the creation of the assets themselves. So by the time you've stabilized your asset, you have an equity buffer within your capital stack that wouldn't exist if you bought it on the open market. If you're buying on the open market, you're paying market prices. Any sort of downturn is going to hit your equity pretty quickly. You don't have that buffer. And then newly built assets, just by the very nature that they're new, and our strategy focuses heavily on the durability of these assets for the long term, but they have less operating and capital expenditure risk over the long term. The next point I want to touch on that is I think kind of key to our strategy is how we go about our financing for our portfolio. So we utilize CMHC's Apartment Construction Loan Program, or ACLP. This program, because of our sustainability and energy efficient design and some other factors that allow us to qualify for this program, we're able to utilize low cost, long-term government guaranteed financing. So, this is 10-year fixed debt that is at the government rate of borrowing. So it's very attractive debt, highly beneficial for the portfolio. And then, when we created this fund, we worked heavily with CMHC to really try to figure out how we could design a fund to utilize some of the various incentives that are out there, not just at the federal level, but at various levels. And through that process and through having CMHC understand our portfolio and what we're trying to do, we've actually received a $40 million forgivable zero interest loan that sits inside of the fund. This initially served as a seed investment. It lowers our overall cost of capital and enhances some downside protection for investors. Also buffers returns on the upside as well. I talked a bit in the previous couple slides about just the de-risking and the decoupling of development risk versus the development value creation. So we're passing on the upside to investors while taking on any planning and approval risk outside of the fund. So that's a huge differentiator that's not typically available to investors if they're getting exposed to like a true development deal. And then we'll talk about this in the next couple of slides, but how we approach our energy efficiency and sustainability strategy. We're of the mindset that energy efficiency and sustainability should be value creators or cost saving strategies. So we're laser focused on that, on how those approaches can increase operating income or enhance asset value. And then we view, when you look at the changing climate, both in terms of the actual climate and just the regulatory climate, we view over the long term having buildings that are insulated against any climate risk or future regulatory risk. We're seeing things like insurance in the next several years. Buildings that aren't climate resilient are going to have a much harder time getting insured, and then things like that are going to affect overall valuation and portfolio value over the long term. So that's how we sort of approach the sustainability part of our strategy. So next slide here. So we're a part of a lot of these various organizations and initiatives, and like I said, we're creating value through our approach. We view this as future proofing the assets. We use a lot of different strategies to deliver an institutional quality portfolio and offer long-term value creation. So let's talk about that in a little bit more detail on the next slide here of how we actually do that. So we really think about this through kind of all aspects of the building life cycle. So if you want to kind of break this down into sort of the three main phases of a building, in the planning and design process, we're designing highly energy efficient buildings just from a design standpoint. This is things like better insulation, finding kind of optimal layouts in the building for energy efficiency. Through the construction phase, we're utilizing a bunch of different technologies to reduce construction costs, mainly through just time savings. So anything under 18 stories in our portfolio, which is the bulk of our portfolio, is mass timber. This can be factory produced and assembled on site quicker. It's more energy efficient. It obviously is less carbon intensive as well. We use some prefabricated external facades that also enhance both the quality control of our buildings, the air tightness, which has a big impact on energy efficiency. Anyone that's lived in anywhere that's had a draft or a not energy efficient window will know how big of a difference that can have on your energy costs. And then we utilize a bunch of different energy technologies throughout the operation of the building. So we use geothermal heating and cooling, rooftop solar, to really drive down our energy costs, to use kind of some real numbers and to give a sense of how that actually affects the portfolio. Our typical kind of 150 unit building saves about $300,000 a year in energy costs compared to a typical kind of code comparable building. And when you think about those $300,000 in savings on energy costs, your portfolio is the value of it is driven by a factor of your net operating income, right? So if you're having $300,000 in savings on your utility costs, that's directly enhancing your net operating income, which is going to have an effect over the long term on the overall value of the portfolio. So I think that's a good example of kind of how we view implementing these technologies, where we're laser focused on how they can drive value. And then the units themselves, we have our tenants in mind. These are beautiful design-driven buildings. Obviously, David, one of our co-founders that I mentioned, had his background being in architecture, has a strong passion for this type of design. We have a bunch of other team members on staff with similar backgrounds, and again, this is really done for our overall strategy as well. I personally like the values alignment here, where our biggest risk on the tenant side is turnover. So how do you reduce turnover? You have tenants want to stay, want to live there, and be happy over the long term. So we design these with that in mind. They're very livable layouts. Depending on the area, that can be different kind of makeup of units. Maybe in more kind of family driven areas, they're slightly larger layouts. We utilize a lot of data on the amenities, so it's not just kind of putting in a big flashy amenity just because. It's putting in useful amenities, useful kind of design touches to the building, because again, we want tenants to stay for the long term, because for newer builds, we're not constrained by rent control. We're at market rent from day one. So when you can compare that to like a value add type approach, where in a lot of cases you actually do want to drive turnover, because you're trying to bump up below market rents. In our case, we're at market rents from day one, and we want to have people stay over the long term. Easier to keep a good tenant happy than trying to constantly be replacing tenants. So just kind of to recap on some of the differentiators here. So we utilize an institutional capital strategy that a lot of the larger institutional investors around the world utilize. I think it's somewhat unique for individual high net worth investors to be exposed to a strategy like this, to have both the growth and income within one fund. Some of the financing advantages that we have through our seed investment, that $40 million forgivable loan that really enhances the returns, to some of the different public initiatives that we use at kind of all layers of government. And we view that as a strong value enhancer over kind of the next several years in rental, as governments try to deliver more housing. Our open-ended structure is very tax efficient. It's eligible for registered funds as well. But even if you're not investing through a registered fund, the overall portfolio and open-ended mutual fund trust is a very tax efficient structure. And then the other key differentiator that I've kind of harped on a few times now, but is worth repeating, is the value creation that we're delivering from the development upside, while not exposing the investor to any sort of planning or approval risk. And so I'll kind of start closing out a little bit here with some pictures of the portfolio. So this is one of our completed sites that's currently leasing in Hamilton. Beautiful site. This is one of the pictures of the model suite. It's actively leasing now. We're very happy with the progress. So you can kind of get a sense for the design and the look and feel. I love the on the left here, the bedroom with the skylight. Again, it's the attention to detail on the units themselves that might not necessarily cost any more, but really just make them places that people are going to want to live. Go to the next one here. So this is one of our sites on the east end of Toronto that will be into construction this year. We're excited about that. Great kind of courtyard, park, some community space within the building as well. Go to the next slide here. So this is our Mississauga site that will also be entering construction in the next couple months. Great site. Again, great kind of interior courtyard that residents can hang out in and have some great space. Next one here. So this is one of our kind of marquee assets in the portfolio, and I think is a great sort of example of how we create value for our investors by really having a strong sense of navigating the planning and approval process. So this site, it's in downtown Toronto. It has heritage on the site, as you can see by this existing facade that we're going to keep, and then we'll have a 46-story tower coming out of it. We got this approved in 100 business days, which, if you've been around development, is quite an impressive feat. And I think, again, just speaks to how we've been able to work with different cities and municipalities on delivering rental housing. So just to close out here and to kind of recap on the return side, obviously as investors, we want to know what's going to happen with our investment. So this investment really for the initial kind of 4 or 5 years is a capital growth and capital appreciation investment. We will have income starting as the portfolio is built and as these different buildings of the 14 start to come online. But the income doesn't really ramp up kind of more until year 5, 6, 7. So the open-ended nature of the fund, investors can come in and redeem quarterly. So there's the chance to kind of align your own investment time horizon with the strategy. If you want to be in kind of more just for the development uplift, you could come out at 5 years. We've got a 5-year hold on the investment, and then if you wanted to hold a long term, you're earning income off of that enhanced value that you've created over the initial few years. So again, the kind of return metrics you can see here, targeting a bit over a 20% average annual return, strong equity multiple, obviously, and some kind of fund highlights to touch on too. So 25,000 minimum investment. It's open to accredited investors. I touched on the registered plan eligible, so it fits great in an RSP, TFSA, things like that. It doesn't have to be. Again, the tax efficiency of the structure works well, even if it's not registered plan eligible. And then, like I mentioned, quarterly redemptions and quarterly distributions as we go along in the fund. So, yeah, I think that kind of covers everything at a high level on Heartwood. And yeah, again, appreciate being included on the webinar, and it's great to be on the Parvis platform.
Well, Dylan, thank you very much for your time and showing of the fund. Looks very exciting. Any questions do we have for Dylan at this time? Okay, we have one here. Dylan, what differentiates Heartwood from typical other developers within the Greater Toronto area?
Yeah, I think it's a good question. I think it's an important question with the way the market is these days, right? Like I think we had a very long run in the Canadian market, especially the Toronto market, where there was a lot of maybe not as good underwriting or execution that was just sort of masked by a rising tide lifting all boats. Now, as an investor, you got to be a lot more diligent on who the manager is that is operating the investment. So we bring a lot of institutional expertise in terms of our approach and our underwriting and execution. The data that we use, again, I think is very unique in the landscape that we're in. I think the differentiator of not being a merchant developer where we're just trying to build and flip the assets as soon as they're built, that we are the long-term operator of these. Again, it aligns our incentives and strategy to be focused on building durable buildings that are going to last and enhance value over the long term. And then just the systems that we use as well is another thing that I think is a differentiator too.
Do I understand also it's you from project to project, you try to hold on or maintain a relationship with the trades and the builders and everybody else that are working on these projects? I guess a repeatability and basically trying to build things in the same manner. How does that translate to investors as far as of return? Is that have an effect on the bottom line for you guys?
Yeah, so I think that good question, and yeah, to kind of elaborate on the systems point I made at the end of that last answer. So because I think that is a key thing to understand. So because we have a portfolio of these 14 different sites, and we can expand beyond that as the fund grows as well. But having that portfolio at the beginning versus, when a lot of funds start, you would raise capital from investors and then go buy assets or build assets from there. But having this portfolio means that we can iterate and have a systems based approach across the portfolio. So we can negotiate different better pricing with trades as an example. Just things from design and cost savings and learnings that we're able to take from the first project to the next project to the next project. That value compounds over time. So we're seeing that now. We've got 2 of these projects that are complete. We've got a third that's under construction now, and we're already seeing significant cost savings just from some of the value that we've been able to learn through each step of the process. And that is different from a lot of developers. A lot of the time, when you're doing a different site, the sites are different. You're kind of working with different project teams, different consultants. So it's hard to sort of take any learnings from one project to the next. Whereas our strategy is deliberately to kind of iterate and have a system where we can just be constantly kind of compounding that cost saving and value driving advantage over time.
Great. Okay. Well, thanks, Dylan. And for the people out there looking, do you want to explore the strategy a little bit further with us? You can reach out and just scan the code on the screen. We can reach out and have a one-to-one a little bit more about the project, Heartwood Trust Fund. And again, Dylan, wanted to thank you for your time this morning and wishing everybody a great day.
Appreciate it, and thanks everyone for joining. It's fun to be a part of.
All right, take care.